Good turnaround Tuesday, everybody. How's everyone doing? Cable certainly had a turnaround Tuesday in London anyway, didn't wait for us. I think Amanda was hinting that this could happen. Amanda's really been, you know, spot on with what's happened with cable since I've known her. Hello, Sean, Shahab, Brock. So this really spiked EG. And actually, I actually bought it on this candle. It was a mistake. I was thinking we were at 83.80, not 82.80. And people that know me know I don't buy RSI readings at 20, but got out here. I thought it was going to stall here. And here we go. Pretty interesting action back above the wedge line. Probably getting a reversal week to the upside. And I think we talked about this last week that when you look at the monthly chart, that as weak as EG's been, that it could have just been corrective. And we're on the verge after cleaning out everyone under this level and maybe even took out these lows. We could end up closing higher on the month in the next couple days, which could generate, pretty good rally. I always believed that if the dollar was going to weaken, that euro should have more relative strength than the pound. So maybe this is what it's about. The dollar weakening is going to be euro leadership because it's been cable leadership um, all the way down in the dollar mainly. That's why EG did this. Okay, so now if we're turning here, your preferred long is going to be in euro for a while. Okay, unless I'm dead wrong and we're just going to end up puking down here towards the 80 level. But I think this is pretty interesting. Let's see what kind of week we've had here. It's got to be a reversal week. Yeah. Well, we're going to close above the 2 week off number, even though it's only Tuesday. Sure looks like it. And you probably still have a lot of people short, that may not throw in the towel until, you know, maybe this high. So that's my view on European currencies. The yen just isn't done. I didn't think it was done, even though we pulled back from 70 uh, last week, and then we tried it here. So the interesting question is going to be when we get to 109.70. A lot of people are going to be calling it a breakout, and we'll see. I would let it if it broke out. If you want to trade it, fine, but I'm thinking that we could complete something in the one around the 110 handle or so, 110.20, and then I would just wait for the market to negate this quote unquote breakout at this level. So looking at S&Ps, 3,200 was a number, God, I got from an Elliotician about all the way back when I was on FX Street. I think it was Eric Morera. So here we are, 3,200. 4 hour is still diverging. 1 hour isn't. See, we have a confirmed high here, so maybe we're going to get one more blast. And daily, still diverging here. So, call me the boy who cried wolf. Still think we're in a topping situation here. The 4 hour has not confirmed. Pretty good. In fact, we could end up with a 4 hour 2 candle reversal here shortly. And this is really still going to be the key. And so far, after this was after the trade agreement. This was a trade agreement where they just flushed everyone out. This looks like a flag to me. You have a flag pull from here to here, and I think we're building a flag back over 702. I showed the weekly last week, yesterday, so we'll see. Still looks like we could get a run to the upside and break out, and we showed the gold weekly. Gold still looks okay. As long as we hold 1450, back under 1450, I think you're going to be looking at, 1360, 1380. So this is pretty important, and this will tie in with the yen. So the yen's been surging, but gold's been acting pretty good despite, right? So I still think the gold is okay, and I'll believe that till we take out the 1450 level. And silver, I believe, even looks a little better. Well, not on the weekly, but look where it held. Nice pullback, confirmed high on the weekly. I would not be short these metals. Okay. So that's the way it looks to me. Oil keeps chugging along, trying to break out. We're not confirming the high on the 1 hour or the 4 really. So we'll see what kind of action we get on turnaround Tuesday. We have an excellent guest today. Again, we have David Jensen, who's going to talk about what's happening in the repo market. There's a lot of talk about there are going to be a lot of year-end pressures in the overnight repo market. So I'm sure he'll be addressing that and what's going to happen going into 2020. So any questions for me? Brock, Shahab, Sean, anybody? Okay, great. Hi, Blake. How are you, buddy?
Hey, good morning, Dale.
How's it going?
Good, good. I was actually just getting set up. I just shorted some euro pound, some euro
Okay.
sterling.
Hell of a pop.
Yeah, on that little pop. The cable is down at 131.50, which is support. Here, let me go ahead and grab
Okay.
charts here. Uh,
So
okay.
this just viewed as a correction, and you think we'll end up taking out the lows that we had after the vote,
And,
or it's a scalp? You're just
This is
scalping
more of a
around.
scalping around
Okay.
for me because here I'll show you the charts and
Okay, buddy.
use Forex Analytics. You already knew all this stuff because I sent out charts this morning about where key resistance in the euro pound was and key support for the cable. So this is an hourly channel you can see in the pound. Now there is some the reason why the cable's so weak today, from what Amanda has said, is that Boris Johnson says there's still a risk of a a hard Brexit. So those risks have resurfaced in the cable, and you can see the cable's pulled back. This is you notice this dotted line right here. You can see it on my
Yeah,
hour, but
see it.
I have to go out to the daily. Now remember, this is a multi-year trend line, right?
Yeah.
So we're basically testing this multi-year trend line again. Now, do I think it could break? Sure. I'm not going to dispute that. I'm not here to tell you, oh, this is going to hold, but I believe it's so important that it'll probably hold at least on first swipe. So, we're down testing 131.50. The euro also is above the 200-day moving average, but we've seen the euro get hit up here. I'm not sold on the idea just that this at this very moment that the euro is going to blast higher. Now that doesn't mean that the euro can't go higher. As I've stated a lot of times here, I'm a dollar bear, so I think that the euro is eventually going higher. But is today the day? We'll see. Maybe it is, but I think it's holding up well. But at the same time, I think that the cable could get a bounce, and that's more important to me because if you look at the euro uh, sterling, which is right here, okay, this is previous support, current resistance at 85, also channel resistance, previous channel resistance. Now we blasted through the channel, got a false breakdown. We're rallying back to the channel resistance. This false breakdown right here probably will eventually lead to a move higher. Is that going to happen right at this moment? I'm hoping not because I just shorted it at 93. So actually it's 93 and almost 94. So at 80, 84, 94. So, and again, if you use Forex Analytics, let me just go ahead and let's take you over to the Euro Pound. Let's go to the updates from yesterday. The euro pound continues to trade heavy, and while below the 84 level, the risk remains lower. Also note that post UK vote buyers came in ahead of the 127% extension at 82.43. So what that analysis says that if we get above 84, we're going to squeeze, right? And this morning, the euro pound squeezed past the 84 level and will face major downtrend resistance at 85 level should we get there. Well, I mean, mine. You have to give me a, I mean, we hit 84.99 on that spike up, so we hit resistance, really key resistance here. Um, so I shorted it. Now, as I just mentioned in the chat room, so here's the chat room. This is our Forex Analytics chat room. Uh, just shorted at 93. I was jumping on the webinar, so that was about 10 pips ago when I wrote that out. I said I'm only trying to get 30-ish out of it. So I'm not sitting here going to try to get this thing back to 84 pence while we're on here. Maybe if it does drop, that'd be great. But a move back below 84.70 might put back in play in the 50s or 60s, but I'll probably just take it off and scalp my way around because it's the week before Christmas and Christmas holiday, and there's probably going to be pretty dull activity. I mean, it seems like all the action right now is in the European. Um, uh, it's uh, all the actions in the European hours, and it seems like soon as Europe goes home, it is deathly quiet in the FX market. So I'm more in tune of just taking some profits off the table when I can. Okay, so let's talk about a couple. Matter of fact, since I'm on the conversation of the euro, let's talk about some of the other pairs that are facing pretty big resistance. Here's the Euro Aussie. Euro Aussie, we've been looking at this 163.25 level for what seems like ever, but it's been for weeks. It is this 618 retracement of this move. So, I'm sorry, 50%, no, 38% retracement of this move. It's sorry, I'm just like trying to think out loud here. The 38% retracement of this move, and it's been capping the Euro Aussie consistently. Today's rally capped right at 163, and I know that a break above 163.25 is going to be bullish, but I know we're right up against resistance. It's held us since the mid-November, or actually, yeah, mid-November, and so we're up here. I know we're at resistance, so again, with me shorting the euro sterling, it's one of those situations. Euro New Zealand, once we broke through 170, that has been resistance. It is also previous support. You can see it right, not there, right here. Previous support, okay, is right at that 170 level, knocking our head up against it again. Eventually, will the euro break out? Yeah, I think so. Is it going to break out, right now? Probably not, and so that's why I'm selling some euro cable. So I guess what I'm trying to show you guys is that I am I'm approaching the market with the euro sterling or the euro pound in a cross rate fashion. I'm looking at the euro dollar, knowing the euro dollar is just above the 200-day moving average, but we tend to struggle up here. We have for a while. So knowing the euro Aussie, at resistance, euro New Zealand at resistance, well, euro sterling is at resistance as well. And like I said, I'm just going to try to pull, I'm up about almost 20 pips. I'm going to try to pull another 10, 15 pips out of it, and that'll be it. I might, hey, you know what? I'm going to do that right now. I'm going to move my stop to break even right now. And so this way I'm in a riskless trade. So now I just did. So I just moved my stop to break even, and now I'm just going to sit in it for a little bit while I'm sitting here chit-chatting with you guys. Let's see. What else do we got going on? A couple other things that I think that we should note. First and foremost, gold. I know we talk about it, how bullish gold looks. Adam Button was on here yesterday from Forex Live. He was, talking about uh, he was talking about how. Hold on. Oh, this is Joe's. I was wondering, that's not my writing, my drawing. Hold on. Let me go. Okay, here we go. Here's gold. And I know gold is, knocking its head up against resistance as well. The thing about gold is it's not pulling back. It's not. Um, does that saying it won't? No, but the fact of the matter, with everything going on, with all of this positive news that we've seen, especially this last week, I continue to wonder why in God's name gold is not lower. Now, it may go lower, but the longer it sits at these levels, the longer the stock market sits here and it doesn't, blast to new highs. If we start to see some profit taking in the equity markets, you're going to see gold rally, and that to me is pretty apparent. Um, does that mean you should be loading the boat with gold right now? No, I don't know, because I'm not 100% convinced that the stock market is done going up. That's that's my my biggest fear with the gold market is, you look at the stock market, and it's still just grinding higher, and we're, still in that this breakout territory, and we could accelerate higher, even though we're at some pretty key resistance levels at the moment, with a couple 161% extensions, really capping the current rally. But you know, if because if the stock market continues higher, then gold should push lower. But it is holding up well, and that's the thing that you have to keep in mind, that if the stock market really starts to see a little bit of selling pressure, gold is likely to break out, and you can see relative strength is trying to make a move here. And look at silver. Silver is at a decent, now remember, silver just absolutely destroyed shorts this last year. If you guys don't remember the move this summer, I mean, silver, let's look from a percentage standpoint. And Stelios was all over this. We went from 14 bucks to 19. That's a 40% move. 40% move in just like a month and a half. I saw traders trying to sit in front of this move as it was happening, and I'm like, oh God, that's very, very dangerous. Well, we've pulled back near the 618, not even quite to the 618. We're consolidating in a very similar fashion to gold. It's just not really pulling back. And can silver move down to 1650? Yes, because if stocks continue higher, silver's probably going to fail here. And matter of fact, if you guys are uh, 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 precious metal bears, well, this is the best place for you to short silver, right? Because your risk. Your risk is above here. Your risk is above 17 and a quarter, and I know there's plenty of you guys that are precious metal bears. So this is where you probably, from a risk reward standpoint, need to take your stand. Now, if silver starts breaking above 17 and a quarter, that's going to be a fairly bullish event, in my opinion. We're probably going to be heading back above 1850, would be my best guess. So again, I'm just trying to point out that gold and silver are holding up relatively well, and in the face of all of this positive news out of the equity markets. Um, and why? I'm still scratching my head why, but that provides us opportunity in the event that we start to see some stock market selling, which seems like a you know never ending laughable joke, because stocks just don't go down, at least not in this current environment. But it doesn't mean that it can't, garner our attention in the event of, because at some point stocks will go down. They just will. I mean, that is the market. The market goes up and down, not just straight up and not just straight down. And usually the stronger and farther and harder you go up or down, the more violent the the flip side of that move is going to be. We've been moving up in equities for nearly 10 years. There are a lot of traders on the street that are in trading desks that never seen, less than a 20% blip in the market. And so, the longer we, go up, and the further we grind higher, the likely the stronger the fall will be when it happens. Like I said, I don't think it's going to happen necessarily today, but it could, and if it does, then we all have to be looking at what is, what's going to be the move. And I think the move would be in precious metals. All right. It looks like there were a couple comments that came in. So let me see if I'll go to the chat box and just see if um, FX Cole says euro is going to blast higher, euro pound too. I mean, I think the euro is going higher. The euro cable, I'm still, I may be short right now, but I don't. I'm on the fence about that. I think that the pound is. It depends what economic data does this next year, but I think there's a lot of pent up demand in the UK. So, and I've always been a believer of that that economic data might turn sharply higher. Excuse me, for the UK, which I think is going to be sterling positive, but that's to be seen. Deepak says, hey guys, good morning. Could you please evaluate the New Zealand US dollar? Yeah, I'll give you a quick look at the Kiwi. We have a head and shoulder pattern. And the scary thing about the New Zealand dollar is we were above this multi-year trend line. It was looking very bullish because we have this big longer term inverted head and shoulder pattern. But now it looks like we're going to fail back to the 200-day moving average. And this is going to be this would be a big blow to bulls right now. So if you just do this, okay, I see the head and shoulder pattern. The measurement takes us back to 65.30. 65.30 is the 200-day moving average. If you want to be a buyer and buy dips in the pair, that's probably the place to do it, right? Let that little intraday head and shoulder pattern complete. Catherine says, hey, Blake, would love your view on the Euro Mexican peso. Thanks. And hey, Catherine, how's it going? Why aren't you in the chat room? Huh? No, I know it's holidays. Catherine's a longtime staple in our chat room. We miss you. All right. So anyway, let's take a look at the Euro Mexican peso. So we are at really key support. The one thing that scares me about the peso right now is that we have broken below the 19 level. My view on the dollar mex, by the way, is this. We're breaking this little triangle, but it's a big deal actually. The market is extremely long pesos, extremely. I think we're doing this. Just FYI, but that means that the Mexican peso could strengthen a little bit more before reversing. I think this is one of those that's going to, get everybody even more bullish the peso, and then we're going to see some sort of reversal. But that has to come with risk aversion. So right now, the dollar Mexican peso looks like we're going to like 1880, maybe even 1860. So depends on what the euro does here, but the euro peso could probably look something like this. I think you got to give it a little room if you're long, and if you're short, I think you have to be really careful until it breaks 21. So maybe below 21, and then it turns, then we're just, straight up bearish. But because of my bullish nature of the euro at this time, I think the risk of a squeeze higher is there. Obviously I don't turn bullish until you get above this trend line here, but I think the Euro Mexican peso is at a very, very critical level for the market. Okay. All right. So I'm going to pass it over to my colleague Steven Stelios here in a moment, but I just want to say good morning to you guys. Good morning, guys.
Good morning, Blake.
Good morning.
Good morning, Blake.
So Stelios can tell us about Brexit.
Yes, I can.
Oh, hey, usually you're like, screw you. I'm not saying anything. I'm done. No, so why is the cable weaker today?
Well, we
I know
get
Amanda had alluded to
yeah.
some comments from Boris Johnson, but what's going on here with the cable?
Well, I like the whole Brexit thing now because we're getting some movement as opposed to this will they, won't they for all these months before. So, like you very correctly said, Amanda said that yesterday, I think she said, I think it's very possible that Boris Johnson is going to bring back to the table the no Brexit scenario. And just think about it, okay? He's just won an election, big majority. He can do anything he wants, and now he's got the difficult task of actually agreeing something with the Europeans, right? I mean, they have already agreed something, but he has to push it through Parliament. They have to go through all the details, etc. What we've said this before. What weapon does the UK have? They have the No Deal Brexit weapon because they're, if that happens, obviously the UK is going to be in a bit of trouble. But also, the EU do not want a No Deal Brexit. I mean, I think that goes without saying. So what does he do? He brings it back to the table and he says, look, we're leaving the EU on which date was it, in 2020? It was basically
January 30th, isn't it?
Not January 2020. It's not in a month. It's sometime late 2020. Somebody can help me with that. But anyway, he says, look, we're leaving by this date, no matter what. If we found December 2020, thank you. So it's a year from now. Thank you, Ayaz. So he says, look, we're leaving no matter what. We have a year to iron out the details. There's going to be no extension. So effectively, he's really, shoving it to the Europeans and saying, look, we have to do something. We have to agree on something. Otherwise, there's going to be trouble for both sides. And that kind of makes sense. If you take that weapon away, the Europeans are going to just sit back and say, yeah, we're going to take our time and see if we can agree on something. Otherwise, we can have another extension, and nothing's going to ever change.
Yeah.
So this is what's happened. Of course, naturally, the markets had been pricing near zero chance of a no-deal Brexit. Now it's come back. So it makes sense that the pound is weaker. I personally still think that no-deal Brexit will be avoided. And every sign that we've seen from both sides shows that this is what they want. So I still like the pound for the medium term, but it's going to be choppy, just like it is today, and it might continue. So that's where we are. We're going to have to wait and see what transpires in the next year or so. But it's far from over, and we still have a lot of crap to go through. Pardon my French. So that's my view of Brexit.
All right, great. No, thank you for the update. And I think that was a very good update about what's happening with the sterling. So, and Steve, good morning.
Good morning, Blake.
How are you?
I'm good. How have you been?
My feet are freezing. That doesn't happen often here in Arizona, but when I don't have socks on and it's actually cold, it's cold.
Is it actually cold?
It is cold. It's like the low overnight was near freezing. It's 39 degrees, and that's for us is really cold. Yeah.
Okay.
And for those of you guys that don't know, I do live in Phoenix, Arizona. I very rarely wear shoes unless it's taking my kids to sporting events. That's pretty much, and I have to go to some sort of dinner. I'm pretty much in flip-flops all the time, and that's the benefit of trading from home and trading remotely, and also work and helping navigate all this analysis from home. Unfortunately, mornings like this is I'm going to go throw on some socks anyway. No, all is good, and other than that, I think I want to reiterate that this period of the market, this time of the year, and knowing that we're getting close to the holidays, what we're seeing is liquidity really dry up during the U.S. Session once Europe goes home. So, for me, it's like I may be scalping the euro sterling, and a little bit short here. I don't plan on being in it too long, and I'll pull it off. As things die down in the next couple hours. But
Blake, pull up
yeah.
data flash because we have data in 10 seconds.
Oh, all right. Hold on.
Yeah, we have housing data.
There we go.
And housing
it's
data a little bit
better than
better than
expected.
yeah, a little bit better than expected.
Better.
Canadian manufacturing sales negative 0.7 in comparison to 0 expected. So bad Canadian data again.
Yeah. Well, and by the way, speaking of the dollar CAD, and I'll let you take it from here. This is the multi-year trend line, triangle support. We noted it on Forex Analytics yesterday. If you guys are, let me just go ahead and pull it up. So if you guys use Forex Analytics, basic analysis tab is the tab that myself and a few other of us, like Steve, update. You know, the dip below the 128 130 128 level offered a good level for buyers, as this was the multi-year triangle support, and we noted it intraday. This is 127% fib as we are testing the extension below the 130 127 level. RSI 4 hours not oversold. However, this is a long-term uptrend line as well. Bears beware. That was down here yesterday, and we ripped. And like I said, if you're a dollar Canadian bear, you got to be real careful while we're above 131. All right. So that being said, I'm going to pass it to you guys. Have a great day, everybody. Coach, have a wonderful interview, and thank you all for being here. Make sure. Oh, I need to mention our Forest Park FX, our webinar sponsor. If you guys are looking for a broker that will help you best suited for your needs, because that's the key, is, you know, I use a couple of different clearing firms like JP Morgan, Barclays, on an institutional level, and I use Barclays for certain liquidity situations and JP Morgan pretty much consistently, but I have Barclays as a provider when periods of I need more liquidity, and that's imperative that you as a trader have a broker that, you know, best suited for your needs. If you're a huge mega scalper, you're going to be using a different broker than somebody who's just looking for, you know, less rollover fees, maybe a little wider spread, but you don't really care because you're looking for that, you know, 50 or 100 pip gain over the course of a week, you know. So make sure you talk to Forest Park FX. They, like I said, they've been our webinar sponsor for years now. Great group of folks to work with, and they can assist you with being part of the reimbursement program, where you can be a part of the Forex Analytics community, possibly for free. And if you're in North America and you don't qualify for this program, then you can at least get cashback rebates, which Steve will tell you is pretty cool.
Oh yeah, it is pretty cool, and you might even end up staying with your brokerage firm. I mean,
Yeah,
you can stay with
yeah,
your brokerage firm and still participate. I mean, in
yeah.
my case, my broker was one of the ideal ones for my trading style, so I stayed there and still got in the cash
Cashback
rebate
rebate.
program. Yeah, so I had
And because
yeah.
because I didn't cancel your Forex Analytics subscription, so you're good to go.
Thank you, Blake. You're very kind.
Thanks. All right, guys. Hey, have a great one. And I'll see you guys tomorrow.
Thank you, Blake.
Okay, Blake.
Once again, another really great review of markets. Thank you very much, Blake.
Thanks, guys. Thanks,
Talk to you
Stelios.
later. Bye-bye,
Bye.
mate.
Okay, we talked about the main event. I mean, only one more little thing to add on the UK is the numbers we got today. So we had average earnings, which is something that a lot of people look at, and particularly the gap to inflation. Average earnings plus bonus came in at 3.2% year on year. That's weaker than expected, but revision was higher to 3.7. So I think the market took that number as a bit of a non-event, combined also with unemployment ticking down to 3.8%. So now the UK is still near full employment, and earnings versus inflation is still a pretty healthy gap. So not a terrible number, that one. Apart from that, I'm afraid it's been very, very quiet, Mr. Steve.
Yeah, it is. I mean, the main events overnight in the FX world have been the move in the pound, and the pound pairs, obviously. The move in the Aussie, which you can see here. So we've had follow through here, which shows that this rejection we got on Friday was quite a deal, and everything that's affected between them, and definitely we're talking about like a big we hit my second target here at 83. Unfortunately, I wasn't in the trade anymore because that spike over there had stopped out my second half at profit, but still not my second target, which was 83. And we're seeing a very nice morning star formation here in the euro pound. So I was expecting a reaction either from 84 or 83, and we're seeing a very healthy reaction from 83. And I do think that we might see a follow through. I understand why Blake shorted it here because it is resistance. So, as a scalp, it looks like a nice short, but I do think that, especially if we close the day, on a positive note, we should be seeing more upside in the days ahead. So I do think that the euro pound Morningstar formation is worth noting. The cables evening star formation is also worth noting. I think it might, give us more downside and give us an opportunity to buy pound lower, because I still think that the pound should be bought lower. But as I was saying yesterday, the easy part of the move, it was one of these cases, the buy the rumor, sell the news. The market had to reprice things starting in the beginning of the season, meaning in the beginning of September, and it took us from below 120 to 135. I mean, that's a pretty big move for FX, right? So once we got the event, now that was priced in. So now the pound needs to get more news to keep on going. So I wouldn't be surprised to see like a bigger pullback. And as I've said, 130 is a key support area. So I think it might be worth giving it a shot at 130. Now, if we close near the lows today, I do think we're going to see some follow through. So I wouldn't be jumping on buying the pound immediately. I think, giving it a few more days to, to do its thing, to produce a healthy corrective move to this violent move higher, especially now that I bet that it has stopped out like the vast majority of the people that were stubbornly trying to short it when it started looking like the market has to reprice several things. So the market might be easier to move lower, at least in the short term. So as I've said, I have my eyes set on 130. We still have another 150 pips to get there. I'm not personally looking to buy it before we get there. Now, when we go to 130, I'm going to be monitoring price action very, very closely. And if I see, the type of price action that, tells me that, this support is working, I might actually jump on it. So that's what I think about the pound, and especially the euro pound. As I said, I was short the euro pound, but I think I'm ready to take the other side. So if for some reason we get lucky enough and we get a move down to 84, 84.10, even 84.50, you can try. I think I'll actually try buying it, because in euro pound, don't forget the big picture here. The big picture here is that the market, you can see it here. Let me draw on the chart. So the market first took out all the shorts there because that was a higher high, right? And I'm pretty sure that it has done the same with longs down here. So this has been a very tricky market. It got people being long at the worst possible point in time, and it might have triggered people being short at the worst possible point in time. So I think that this market definitely can produce some healthy correction to this move from like 93, whatever it was, down to like 83. Huge move, especially if you consider that usually cross rates between similar pairs like the euro and the pound very rarely produce like violent parabolic moves like the one we've seen here. So pairs like the Aussie Kiwi, the euro pound, very rarely produce that type of moves. So I do think that perhaps it's the right time to be in the other side of the market in the medium term. Now, I'm not saying that it cannot continue lower. It can definitely continue lower. But I do think that, you know, this type of a price action we see today, it's not easy to be a one-day thing. So now that we've already done all that, what I would be looking for would be something like, at the very least, something like this. So even if it is to continue lower, I would expect us to, you know, first reach higher levels before we do that. And I'm not saying it's going to continue lower. It might not, right? But I'm saying that at the very least, even if, you know, this is to continue lower, so if this downtrend is to resume, I think it first needs to, you know, to give us like a bigger correction, so towards like 86 cents, something like that. Okay. So as I said, I think buying like a bigger dip, 84.50, 84, 84.10, should be good to go. Oh, Gregor's with us actually. Okay, Gregor, you're lucky. I saw the message. Okay, let me find you and promote you. Wait, give me a second. Gregor, there you go. Promote to panelist. And let me unmute you. Gregor.
Hey, what's up?
Hey, I'm good, mate. I was just, I don't know if you caught it. I was just saying that today's reversal looks nice in the euro pound. And I think that buying the dip for at least one more move higher towards 86 cents looks like a decent opportunity here to me. I don't know what you think about it.
Yes, actually, I see also on cable reversing from very nice trend line resistance, and looks like that on cable we have an impulsive decline. So this could actually,
yeah, it's a
sense.
beautiful evening star formation here, right? Just look at it even from a candlestick perspective.
Yes,
Nice
so
evening.
it looks like that we are headed lower, yes, for a corrective decline here on cable, which means that even if euro dollar stays sideways, the euro pound, I think, may see higher prices as
Yeah,
well.
I think easily achievable targets. That was what I was saying before. Is 130 for the cable and 86 cents for the euro pound. So I think that we can very easily at least make it to those levels, even if the uptrend is to resume in the cable and the downtrend is to resume in the euro pound. I think that after today's moves, we should see at least an extension.
Yeah, I agree.
Okay, so why don't you take the screen, because I'm here every day.
Yes, I will. Just
And you know, I started from those, and I also was about to mention the big failure. I mean, I did mention yesterday the big failure that we had on Friday, having to do with the Aussie against the USD, and today we seem to be producing follow through. So that was another thing that was in my radar. I don't know if you want to mention that as well, or what's your opinion on the Aussie?
I will firstly cover the euro pound since you mentioned it.
Mm-hmm.
So euro pound, I have been looking down this year for a drop into wave C, and I also think that we may see more upside. But I would be very careful as long we are trading here below this trend line resistance. It can be potential resistance, but at the same time we have to consider that minimum requirements for this drop, for this
have
wave,
already been met.
yes, exactly, because market, as you can see,
Yes.
reached very important level, cleared some stops, and now
Yeah, that's what I said. They first cleared all the long positions, all the short positions
and
up in that high at 93.24, and now they marginally cleared all short positions.
yes, exactly. So that's why we are seeing such a nice aggressive recovery. So, but still, I mean, there is FIP targets are definitely much lower here. I think that 61.8% it's very important. And what really is interesting is that this 100%, which means equality of wave C compared to wave A, also comes in right at this level. The next important thing is that this wave B, which is a higher degree correction, still didn't step into the territory of a wave 4, which is also very important guideline. So I think still that these lower prices actually can be achievable. That's why I'm looking for this wave count. I'm looking at a wave 1, wave 2, and then you have an extended
Wave 3.
for a wave 3, and now you are in a wave 4. Now the question is when I would be looking maybe for a bottom in place. Only if I see this trend line resistance broken.
Being taken out.
Yes,
Yeah.
if this trend line resistance is taken out, then of course I would start switching my wave counts. Of course, it will also depend what kind of a recovery we will have at that time. If we'll be in 5 waves, then obviously it would be very bullish indication. If only in 3 waves, I will have to adjust the wave counts and still looking.
I think we're going to see 86 cents, and we take it from there.
Yes, I also think that at least for now, I mean, if I respect what is going on right now, we came down, we cleared those stops above these levels, which was what, low from 2016. So I think that now we are recovering and we'll see more upside. And if I look on cable to give you the whole perspective about the pound, is actually we came very nicely to the downside, and once more we made a new swing low right now. So I'm seeing a lot of interesting price action, which actually suggests, just let me label this, which actually suggests that this is an impulse from the highs. Okay.
So 130 is going to be strong support. We should see a reaction from there, one way or another.
I mean, the strong move on pound came exactly here that we are right now. Okay, last week. So I think that when this such a strong move is completely erased, that's when market actually may slow down a little bit. So yeah, sooner or later, I think that the new corrective recovery in 3 waves will occur, and then more weakness. But what I really like about 4-hour chart is that actually we are seeing this current reversal, after market made 5 waves up here. So despite this very strong move that occurred last week, I was still tracking potential 5th wave highs, and I was aware of potential reversal. Also because we have seen this recent break, very strong break out of a triangle, and you know the triangles occur
terminal formation. Yeah.
So I knew that this is likely going to be a final stages of a higher degree trend. Also, where this cable stopped recently, it stopped exactly at this trend line resistance. It's very similar, but the opposite side, what we have been experienced here at the bottom at the in September actually of 2019. So if market was very bearish, okay, in August at the end of summer here, and still market then turned to the upside very aggressively, then there is definitely a very good chance that something similar will happen up there. Markets are being very bullish pound, but now again, the flow can change, because if it changed on there, then definitely it can change up here. Also, there's a very nice pattern, a potentially expanding triangle here when you have wave A, B, C, D, and E. So I would be looking for more weakness. Of course, there are also other interpretations where this rise can actually be, let me just find this count, can actually be a flat A, B, C, okay? And you have 5 waves up for a wave C. Also, we stopped right at this very important resistance line. In wave C of an expanded flat, you will see that wave C will clear the levels above wave A before market turns the direction that no one expects. Even if I would erase all of these levels, and I would say that we have 5 waves up, you still would expect a 3-wave retracement, right? So
correct.
You would be looking back to the area of a former wave 4.
Before higher.
Still, yes, and this is still at 1.28 level. So no matter how I look at pound from different perspectives, I think
at least in the short term, the path of least resistance is lower.
That there is going to be lower prices, yes. Also, you mentioned what Aussie?
Yeah, the rejection from the 61.8 and quite key resistance area on Friday, which seems to be producing follow through. What do you think about it?
Yeah, I mean, just let me erase this. Okay, so Aussie, I mean, always when something like that happens, I haven't been bearish Aussie, since market actually turned it down and made, back then I counted this as a 5-wave drop. Obviously I was wrong on that one. Market moved to a new high, but now it's turning. So always when something like that happens, I make a step back and check and remind myself what is going on a higher degree time frame charts. Looking at the monthly charts, still there's a downtrend. We also fell out of this upward channel that was in place since start of 2001. So I'm definitely seeing a bearish activity here. So I want to make the wave counting in this direction. Now looking at the weekly chart here, we can be possibly in a fifth wave, but there are the fifth targets of fifth wave still a little bit lower. You have room here for another 300 pips of drop, maybe even 600 or 800 towards these few levels. And what is most interesting is probably the daily chart, okay? Since market turned up, firstly here at the start of 2019, this was only a 3-wave rise, okay? And then we have seen a retest of these lows, and again, only a 3-wave rise. So we do not have any aggressive bullish interpretations or bullish impulsive structures that will say us that actually market has bottomed. So I came out with this idea that actually this can be maybe some kind of a triangle here in a wave 4, and that we will see breakout next year. Also, there was a very volatile moves here at the end of December last year and in January. So maybe now it's again coming into this time horizon where we may experience a breakout. I think that January can be a very volatile month. So based on this, I'm expecting more Aussie weakness.
Yeah, I'm with you in what sense? I kept saying that I believe that Aussie can really squeeze people as long as we close above 69.30, and we haven't. So, you know, the fact that the market failed to do so, and it failed on a Friday after intraday looking like it was going to break out, you know, not a good signal to me. So,
yeah, but of
you
course,
know,
bulls we're not here for a long time. We are already
yeah. So as long as we stay 69.30, as I've said, I mean, no matter how much I would have liked to see a close above it, because then I believe it, you know, we would get a nice squeeze. You know, there is absolutely no technical interpretation that you can give to say, you know, I want to be bullish. I mean, you want to be bullish, wait for a close above 69.30, and then yeah, sure. But until then, as you've said, we're in a long-term downtrend.
But even even if we would go back to 69, 30, 40, I would be still very skeptical, because based on Elliott wave interpretations, we now fell back into this range. So let's imagine that this was wave 1, wave 2, wave 3, wave 4. And if you are bullish, okay, then this should not be overlapped. Okay,
yeah.
So because it's overlapping price action, it just
it can't be a 5-wave move. Yeah.
Yes, it just confirms that this whole rise is probably corrective. Either WXY or maybe something else is going on here. But sooner or later, I think that Aussie will see more weakness. The next chart is also, I think, very important. What I'm looking at is dollar at Chinese yuan. As you know, this one is very important for Aussie as well. So if this market moves to the upside, I'm expecting Aussie to drop. And what I'm looking at here is that actually market tested this trend line resistance, potentially building a wedge here from these lows, okay? Also, if I look at the whole structure here from 2014 lows, notice that this has been first leg of recovery, then a pullback, and then a third leg. So I would label this as a wave A, B, and C.
With C being an ascending wedge, huh?
Select different levels. Okay, A, B, C. And as you know, wave C should be made by 5 waves, okay? Ideally, that's an ending diagonal here for wave C. So if the 5th wave is really coming in play, that's a perfect timing when actually Aussie could come under pressure as well. And the most important for me is definitely this trend line, because I was watching this trend line when market was actually dropping here last week, but I immediately saw that market quite quickly recovered away from it. It actually rejected lower prices. So in my opinion, this can be seen as a corrective wave 4, and we'll see more upside. Okay, so this obviously makes sense when I'm bearish on Aussie. Even if I look at the Hang Seng index, okay, notice this recovery here from August 2019. It cannot be counted impulsively or bullish. it can
Yeah,
be
very
some correction
overlapping.
in play, very overlapping. Of course, there can be upper channel resistance retested before we going lower. But if this market really turns down, that's when Aussie can also come under pressure because it's very sensitive, obviously, to risk-off moves.
Speaking of which, and since you're talking about correlated markets, I had indicated a nice breakout that happened some time ago in copper. So copper has done a nice move to the upside, but copper is also nearing an important level of resistance at 285. So what do you think about copper? Because this is also quite correlated to many of the things you showed us.
Let me just try. I will just try to find copper here. Just a second. Okay, I think I have it.
Somebody's saying gold is collapsing. Let me have a look.
That's a strong word.
Yeah, what kind of time frame are you looking at? I mean, on my daily chart, it's like a blip.
Bitcoin has been collapsing.
That's true. That is true.
Here, okay, what I have on copper? Well, we are seeing the corrective phase here. We touched these lows at the 61.8%. I must admit that this was quite significant level down there.
Indeed.
Okay? Yes, I think that when talking about the commodities in general, I think that there will be maybe a decade, there will be a very good opportunities in commodities, and copper.
I agree 100%.
And copper could actually be one on the top of my list, actually. I mean, we have seen a very nice 5-wave recovery here from 2015 lows, and then we pulled back so far with overlapping price action, because this ABC rise, as you can see, moved here above this towards 3.0 level, right? So it looks like it's a correction. I'm not sure if this correction is already finished here, or is this just another ABC and we'll see a retest of 61.8%. But I think that sooner or later, this market will actually recover. Now, to make maybe a correlation is not that tight with the Aussie lately, but maybe if Aussie will see that fifth wave drop, maybe this one can pull it a little bit lower as well, or at least stay sideways before market jumps. But when it comes to trading, I mean, I would rather look at copper like from an investing perspective. Okay, I'm planning to add some copper to my portfolios from based on ETFs, and also we'll look maybe to add a little bit lower if we see more weakness here.
I think the theme of the next decade, I mean, doesn't have to be from the first day, of course, of the next decade. That starts in a month. The general theme, though, of the next decade is going to be dollar underperformance, commodity overperformance, US stocks underperformance. I think it's going to be totally different than the one we had this decade.
Yes, I mean, if you look at, I mean, the most important, I don't have this chart now, but the most important is probably commodities S&P 500 ratio charts. We are trading at the bottom of the last 50 years.
And as we very well know, commodities always have a fat tail on the right-hand side, not on the left-hand side, because they're tangible things. I mean, their price can't really go lower below some point because there is always, cost of extraction. Cost of extraction. I mean, nobody's going to, for example, keep extracting like a metal for a long period of time by losing money, or crude, or copper, or whatever else. So there is, in essence, there is an actual limit in how low commodities can go, because they have actual costs for producing them, extracting them, manufacturing them. Depends on what kind. Yeah. So
storage and so on.
Exactly. They have all those costs that nobody's gonna be willing to to bear for more than a few months if the price makes no sense anymore. We have a few questions for you. One has to do with the CAD yen.
It's interview time, Steve.
Oh, yeah, time flies by.
Yeah.
Okay.
Look, maybe I will
Why
do
don't
again
you?
a webinar maybe on Thursday, Friday.
Okay, cool. Why don't you, stop by for another like 20 minutes?
Yeah, sure.
Perfect.
Sure.
Okay.
Thanks, Grega.
Thanks.
Thank you, Grega.
Bye.
See
Bye-bye,
ya.
mate.
See you, Steve.
Who do we have today, coach?
David Jensen.
Okay, perfect.
Okay. Good morning, David. I know it's early for you too. You're on
Yes,
the
it
West
is.
Coast?
On the left coast.
Left Coast, yeah. I used to say my life is like a farmer, up before sunrise, asleep after sundown, except that I nurture seeds of greed for the harvest of commissions.
Okay.
Anyway, so that was Farmer Dale, and you know how to share, right, David? Do you have anything you want to show, or do you want me to put
Yes.
Twitter up?
No, I would like to share. Let me just see if
Okay.
I can.
There's a green button.
Yeah.
Yeah, I
In
gotta
the-
pull up the screen first.
Yeah, in the drop-down menu of.
There we go.
Have you ever nurtured seeds of greed for the harvest of commissions, David? Come on,
nurture-
admit it.
Yes, absolutely. Yeah.
Okay. Okay. We have a
Guilty as
confession.
charged.
Yeah. We're only human, you know. I mean, we have to make money. So, okay, David. Thanks so much for stepping up and coming in today. And, you know, there's a lot of chatter about the repo market, some type of
Yeah.
year-end squeeze. You gonna address that?
Yeah, and then also a little bit about what we're seeing in the metals markets as well, if
Okay.
we can.
Sure.
Maybe as a side note to start, I'm calling in from Vancouver, Canada, and I was looking at Canada's balance sheet on the weekend. This might sound like a little bit of a divergence where we're going, but it all goes in kind of the same direction. But I looked at Canada's national balance sheet, which is put out by Statistics Canada. And to give you a sense of, it's not just the US that's credit dependent, but Canada. In the last 12 months, Canada's total outstanding debt, and that's federal, provincial, corporate, consumer, the whole ball of wax, municipal, etc., increased by $734 billion. And to give you a sense in Canadian dollars, that's about a $2.3 trillion economy. So you're talking about a 31% increase in outstanding credit in 1 year, 734 billion in a $2.3 trillion economy.
Housing related?
A lot of it is corporate.
Okay.
Some of it is housing for sure.
Okay.
But
Because we know there's like prices are pretty extreme.
Yeah.
Right. So
the oil producers here in the tar sands are in difficulty, and they're borrowing as much as they can, as often as they can, to keep their noses. But everything, Dale, in these credit cycles, what happens is it goes faster and faster until it stops. And historically, that's what happened with Weimar. And I think that's what I'm seeing here in Canada and in the US as well. And that's why it's so critical, not to cut off the credit suddenly. You've got to restructure it. But, so the comments, I posted it on Twitter, and the comments were Canada's credit rating is AAA. What are you talking about? And,
okay.
That's just the federal debt is AAA. But when you look at these things, people say, well, our credit rating is good, and, how could there possibly be anything wrong? I always like to pop this chart up.
Yeah.
And this was the Enron chart.
Yeah.
And you can see here.
A little late on the downgrade.
They were
they couldn't upgrade it from there. So bankrupt. Let me ask you this, David. I'm really not sure. Does bankruptcy affect your credit rating? It actually cleans it up, doesn't it? Cleans it up.
Eventually it does, but initially it takes away your access to credit for a period of time.
You mean I can't go to Union Bank today and go, listen, I'm broke, I'm in debt, I'd like a
yeah,
personal loan. I want to take a vacation to Hawaii.
right. You got 100 million.
It's not going to happen. Yeah. So you have to be deeper into the bank.
Yeah.
It's better to be deeper in debt at times, isn't it?
Well,
You
that
get a
was
bank to work with you.
President Trump's
Oh,
statement to the bankers, right? Is
yeah.
if I owe you 100 million and I can't pay it. Sorry, no, if I owe you $100 and I can't pay it, I got a problem. If I owe you 100 million and I can't pay it, you've got a problem, right? And
He's the king of debt. He
yeah,
said that. So
and this is that
all
last
right.
curve reminded me of this one, which is 1,000 days in the life of a turkey. Everything looks good until the last day here,
Gosh, poor
right?
turkey.
That's
Yeah.
that's criticality theory, and it's a bit of a joke, but it is what applies in natural systems. In non-digital systems, criticality theory is the failures come very quickly and they come suddenly.
Yeah, it's like, for a while, some issue may
That's
not
right.
matter. It doesn't matter. It doesn't matter.
Right.
Like maybe impeachment. It doesn't matter. And then all
Right.
of a sudden there's a tipping point.
That's right.
And then what didn't matter matters dramatically
all of a sudden, and it's the
Yeah.
most important thing in the world.
Yeah.
So maybe just a quick recap here. Sorry, my slides got out of order a little bit, by the way. I don't know why they popped up to this mode, but let's just
Poor
close that
turkey.
one. Poor turkey. So just a quick recap here about this. In a credit bubble economy, the critical thing is that you maintain the flows of your money supply. So the blue line is your annual rate of change, and this is 0%. It's probably too small for you to read, and there's 18%.
Right.
So there was the reflation after the dot-com. This is the twin horns of reflation after the GFC, Great Financial Crisis, and I'm maintaining that we're heading into another one now because they've cut off the money supply. And the reason the money supply is so important is, let's go.
Did the Fed exacerbate it by not doing anything at this last meeting? I mean, I know there's a big lag, but I mean, if they can see the same charts you are, why would they pause if we're already heading into something that they caused through QT?
If you read Powell's speeches, I think that he really fervently believed what he did personally. But I call him Lee Harvey Powell, because for me, he's just the guy that arrives at the scene that gets to hold the bag at the end.
Okay.
I don't think that he fully understood comprehended what he was doing. I think the Fed was headed. I mean, it was Yellen that started the cuts, and the cuts were almost done by the time that he came in. I mean, he came in the middle of 2017, right? So he came in here.
QT, QT Yellen started.
This is where Powell showed up right here, right?
Okay.
In the middle of 2017.
Right.
So sorry, right here. That's where he showed up.
And he didn't stop until a year ago.
Yeah.
He stopped it a year ago when Yellen and Bernanke and him were singing Kumbaya together.
Well, the markets had a fit in December of last year at the year end, right? So and the reason it's important that you can't cut the money supply is this ratio here. Here's your repo market, 5 trillion. Here's your 14 trillion of cash in the system. Here's your 72 trillion of debt that it has to service. So there's your 5-to-1 ratio. So just a quick recap here, right? And this is, of course, the derivatives, 200 trillion. But it's this ratio here that means that if you cut the money supply, that you're going to have real problems, because you've got the leveraged effect of the lack of liquid currency to service this debt. Not to increase it to keep the bubble going, but just to service the interest on it, which is compounding. And sorry, what happened? Yeah, so what happens when you cut the money supply? Let me just jump here to this one here. So you can see here, this is the Small Business Confidence Index. There's no title on it, but it's from a website called Paychex.com. And Paychex is a payment services company. So Paychex.com.
Okay.
There's 100. So this is the small business confidence index. And this is 2017. You can see that they've gone under 100 on the index, and the rapid decline here. And look what happened back in 2007, 2008. So I mean, these small businesses are the ones that create the majority of the jobs, right? It's not the large cap companies, and that washes. I think I've got this chart up twice here. Sorry, let me close one. So this washes through, the constriction of credit washes through into the economy, and the first ones to see it are the CEOs, and we can see that from the charts here. The orange, CEO confidence, and the purple is the consumer confidence.
Yeah,
look,
they're at opposite extremes.
Opposite extremes. So this goes back to July of this year, but you can see where we are in terms of the confidence of the CEOs. And you can see where we are. They keep talking about, you know, the consumer is strong. The consumer, as the Michigan survey, looks really good right now. Things are great.
Do you think it's just because of the news flow of stock markets going to new all-time highs, even though a lot of consumers don't even own equity? They just think everything's okay because the stock market is going up.
Yeah, and I think it goes, I mean, I think it goes as crazy as it sounds. I think it goes back to that Turkey index. Things are the very best just before they turn down because of your lack of perception.
Okay.
Right. Things look, or the Enron chart, right? You're really not seeing it until in the last very, very short period. And that's what you mentioned. Who was it that said that, you know, they went bankrupt gradually and then suddenly, right?
Yeah.
That was the old statement. Like, how did you enter bankruptcy? And that was the response was, I went gradually and then all of a sudden, suddenly.
Right.
So
when do you think we're going to have some suddenly happening in some of these financial markets with the backdrop that you've described?
Well, quite soon. Let me just buzz quickly through a couple more charts.
Sure, go ahead.
So this goes to your question about why aren't the market, referring to the markets and how the markets are behaving and the perception of confidence. This is a ratio of tangible book value, and this is Warren Buffett's alleged favorite stock indicator of the value of a company. And so a tangible book value, it knocks out goodwill. And what it does is it gives you a sense of what a company is worth if the cash stops flowing, if it's got a cash flow hiccup. And you can see back here, 1980, it was sub 1%.
That was the bull market. August of 82 was the launch.
Yeah. Oh yeah, the launch of the bull. Yes. Yeah. This was the. I mean, what was the Time magazine cover? The death of equities was, right. I think, 1980, 81. Right.
Right.
So you can see here you're sub 1%, and now we're up at 11 times. I mean, everybody's saying digital now and intellectual property and everything else, but the bottom line here is that we are trading at these extremes, and what we've seen during this entire period is the increase in credit outstanding to the point now where, the U.S. has $73 trillion of total credit, right? Total debt in the system, federal, state, corporate, consumer, municipal, etc.
Okay.
So
we should be looking for a gray shaded area here pretty soon.
Yeah. So let's this next slide here is where I transition into the discussion of the credit markets and what Zoltan Pozsar has been telling us. Are you familiar with Zoltan Pozsar, or Steve?
I've been hearing his name for the past few weeks, but before that, no. So I would say no.
Yeah, you and I mentioned him in the last interview that we did in the middle of November. It's about exactly a month ago. So Zoltan Pozsar comes from the Federal Reserve itself, and he's now at Credit Suisse, as you can see here. And he puts out this global money notes paper. It's free. You can go and download it yourself. This is the December 9th one that he put out. And he is regarded, he's been interviewed so well on Bloomberg and others, but he's very articulate and gives you a tremendously distilled view into what's going on in the markets. But I just want to scroll down to something that he talked about here. And he's talking here about the whole concept that we're seeing here and the issues that we're seeing with the year end coming in, the tightness of the credit, is that he points out that the globally systemic globally systemically important banks, they are now under the Basel III rules, and Basel III requires much higher reserves to be held. And what's happening here is we've got the year end, we've got the turn from 2019 into 2020, and they're having to jack up their reserves to meet the Basel III requirements. And what he's talking about here is the fact of the need for these reserves and to keep the financial system going. And I found this was such a clear statement of his here. He says, if carry makes the world go round and reserves make carry possible, the day we run out of reserves would be the day that the world would stop spinning. And no, this is not an overstatement. And so what he's referring to here is the necessity for the liquidity of the system to be continually available into the market. And if you run out of your reserves, you can no longer have the liquidity supplied. And what we've seen now with, and he mentions in the paper, I won't jump into the detail of it, but he mentions here that JP Morgan was so important in terms of being one of the very few banks, and he calls them the lender of second last resort.
Okay.
Right. So, I mean,
the Fed, then JP Morgan's on deck.
And a couple of others, right? And that they've gone away, and now, and JP Morgan actually sold $130 billion, or took $130 billion of the reserves, pardon me, and then invested them in securities for reasons that I don't understand, but they no longer have the liquidity. And he says this is the first time that we've come into the turn, into the year end, with insufficient liquidity in the system before the turn. Even last year when the markets, they had a tantrum last year, as you probably well recall, for sure well recall. And that this is a situation now which is worse than we have. And I just want to point out one thing that he says here.
One of our attendees, Brock, says that the skew index has turned up sharply. Maybe inability to lower due to repo crisis.
Yeah. Yes. There's a lack of liquidity in the system, and it's very real, and it's going to get worse coming into the year end here. We're not seeing it yet. It happens.
He's also saying Deutsche Bank counterparty risk could be big influence, i.e. repo.
Yeah, I think there are many banks now, and maybe just point out this point right here. Let's see if I can get it to highlight. But so what Poser says in summary, year-end balance sheet constraints, there's a typo there, will preclude primary dealers from bidding for reserves from the Fed through the repo facility or through repos from money funds. So we see the Fed is intervening. I mean, they've got the not QE, the $60 billion a month that they're buying treasuries from the market. But the other intervention they have in the market now, the other primary one that they have in the market right now, is the repo facility. And what he's saying here is that because of the constraints on their balance sheets, the repo facility is a debt facility. And so banks cannot access reserves by taking on more debt. Right? They don't have the balance sheet to reach into the repo facility to get the liquidity that they need.
Interesting.
So
they're basically they're in this process right now where they're going bankrupt slowly, and then all of a sudden
the year end, it's turkey time.
Okay. All right. So when do you figure, like, you know, the last couple days of the year? When
Well, it's kind of like it's a curve that goes exponential, right? So there's a
Okay.
toe of the curve that we're in right
Right.
now, and it gradually increases. But I think what was important was in that paper of his, that monetary notes number 26. I think it's essential reading for anybody that's in the markets. But what he says is that the banks have insufficient reserves
Right.
going into the year end for the first time ever. And he says because of Basel III, they can no longer use the facilities that they had in the past to generate the required liquidity. So here's the Federal Reserve's balance sheet. So this was the taper.
Yeah.
In terms of the QT,
Right.
sorry, and
We're
and
above. We're above from where they started
Right.
already in a
Right.
short period of time.
Yeah. So that's your 60
That's
billion
like
a
an
month.
emergency.
Yes. Yes. Their actions, you know, they betray their statements, right? They're behaving in a way which indicates that they now realize that there's an emergency in that. But this is, see, one other point here, Dale. This is this is in the markets, right? This is not the economy as a whole. And my point is that the whole emergency is being generated by a taking away of liquidity in general, or a major component of it is being generated by the taking away of liquidity by tightening the money supply. And it went on for 2.5, 2.25 years before they started to loosen again.
Right.
But if we go back to the original chart, you can see, whoops. You can see here that, I mean, this is 2001. They loosened into this. This is 2007 in October. And I mean, this is where the crisis occurred. They loosened all the way into these market meltdowns. But your lag is a couple of years with monetary policy. So even if we start to loosen right now,
Which they are.
Okay, you're not going to be able to solve the problems, right? No.
Yeah, we have to pay the piper for QT, and that hasn't happened yet.
Well, and that's the nub of Posar's of his paper, is that repo, they can't access the liquidity through the repo market. The banks can't, and the only way that he can see it is one of two ways: is Canadian banks lending enough into the system for the turn, or the Fed restarting QE again with a QE4. I think QE4 is the most likely one, but again, liquefying after a crisis has started has a whole series of complications to it. A whole series, and I don't understand why the Fed is not acting right now to
Well, that's why I was asking you at the last Fed meeting, why didn't they go a quarter and talk about you know, continuing to ease? If they you know, I still have to think that, you know, you have a lot of wisdom and you're a great researcher, but so are they. They see what you're seeing.
Yeah.
So why didn't they move in December?
Because loosening by lowering rates is something that acts over several years. They've got a problem in a couple of weeks. And I think also there's some politics involved here, is that there's an admission that there's a greater problem in the economy then. Right. They're going to, which is what I maintain. I maintain that there is a problem in the economy because they tightened 3 years ago, the money supply. They're saying this is a technical problem in the markets, which is something that's temporary, and we'll deal with it on a temporary basis.
So, I mean, it's always a chicken and the egg. Sometimes it's something systemic that affects the economy.
Right.
And sometimes it's a bad economy that creates a systemic problem.
Yeah. Or
do we have both happening at the same time?
Yeah. Absolutely.
That's a difference. So, you know, sometimes I mean, really the housing, the Great Recession was really a financial crisis that spilled into the economy, right? You're saying that the economy
yeah, I mean, if you look back, I mean, housing did let go, but the money supply was cut 3 years prior, and it dried out the economy for 3 years.
Same thing was happening.
Right. So it's
Okay.
always there's a proximal cause versus ultimate cause argument, right? And so this will be the proximal cause. This is the tripping crisis, right? And the last time it was Bear Stearns, Lehman Brothers, housing, blah blah blah. That's all they talked about. They didn't talk about the Fed and the money supply and the tightening. So
Okay.
there are always the proximal and ultimate issues, right? And so I'm looking back 3 years saying, hey, they dried out the economy and it's now dry, and they've done it for 2.5 years before they started to loosen, just like they did the last 2 times in 01 and 08. So you can see here the repo rates. This is from yesterday. You can see that they jumped up there, about 8-9 basis points. So even with the awareness of what's going on and the reaching into the markets, they're not able to we'll see going forward, but I would expect this to go much, much higher because there is a liquidity problem. And remember, this is not just your primary dealers in this market. This is pension funds, exchange traded funds, the large brokerages. They're all able to reach into this market if they have assets to access liquidity.
We have an interesting question from an attendee from Giarzhola. If Canadian banks are an option to finance the repo market, is that part of the reason for the sudden selling off of Canadian bank assets? For example, they are selling their operations across the Caribbean urgently?
I think it maybe goes back to the very first thing that I talked about here earlier, is that Canada has a severe credit bubble problem, which appears now to me to be even more advanced than the US in terms of we're running on the spot right now. And I just think in general that there's severe problems, and that the US issues with the US economy impacts us doubly. We've got the tar sands, the turn down in the energy sector,
the
scramble for capital on every front. And I think that the banks can see the level of distress out there.
Right. Okay. Yeah. We were talking about that yesterday with Adam Button about, a lot of paper for the frackers from 5-10 years ago is due, and they have to roll, and there's no one willing because of the quality of the crude, not just the quantity. So it's not just the oil patch in Canada this time. It's Canada.
I don't think you can head into a year end saying, well, maybe the Canadian, but that's what's kind of ironic about Zoltan Pozar's most recent paper there, is that he says your options are Canadian banks of all things, or the Fed stepping in with QE with direct liquidity injections.
Wow, it's really, I'll tell you what, I think I'll stay sober New Year's Eve to watch everything that's, it's interesting. We're only a week or so away to see how all this goes down, and really not that much talk about it out there. I hear a little chatter about it.
Zero. I mean, there's Zoltan Pozar and the odd article of his and the odd recognition of it. But what I find interesting, he says this is the first time that we've entered into the turn with insufficient reserves.
First time.
First time.
So that means it's been a long time, like never before.
Yeah. So we're very, very soon about to see how this all plays out. So so the most likely scenario, I think, is QE4. And what QE4 means is a wall of money coming at us, right? We've had this worsening situation in the markets, and what I found, there was a paper. This is a summary here of commodities which give a leading indicator of inflation. And inflation, I'm using the classic definition of inflation, which is an increase in the money stock, the increase of the money out, which is followed after a lag by, well, first of all, you have juiced capital markets and juiced financial markets, and then ultimately the prices of things rise. But what this study found was that platinum was the first one to move. It had a lead time of about 16 months over a rise in inflation. And that was followed by silver, and then followed by gold with a 12-month lead. The CRB index raw materials are pretty poor and pretty low coefficient.
Yeah.
Right. and crude oil had a negative correlation, so no correlation there. And this is referring now, the reason I'm moving towards this discussion here is from the point of there's a wall of QE4 coming. So looking about what do the markets see? And this is, so platinum was the lead indicator. Then that was the markets, that was the markets from 1972 to 2007. The data, because of course the gold was pinned until 1971.
Right.
So platinum was the primary industrial metal for catalytic converters, but that's switched about 10 years ago to palladium. So here's what palladium has done. This is a 1-year chart here. So you can see here at bottom at about 800, and it's 1986.
Yeah.
Right. So it's gone up $1,100 in the last
Year.
9 months. Yeah, under a
Yeah.
year.
Yeah.
It started to run now. And of course, why would they run? Well, these are such small markets, and all you need is investors at the margins to be stepping into these things that you can't print for them to go much higher very rapidly. So there's palladium, and here's the palladium price going back 5 years. So you can see that it's ramped up materially. So the next one was silver and then gold. Here's an historic look. So this goes right back to 1970. So the orange line is gold.
Yeah.
And you can see platinum has since broken down when they switched over to palladium.
Right.
That's the primary industrial metal now, but you can see that has run really,
huge.
really strongly. Gold, of course, moved up and then down.
And there's silver.
Then there's, silver still asleep, and platinum is still asleep.
Okay, so basically the theme is don't wait to buy gold and wait, and maybe even a little palladium. And
I think things that you can't print are going to get much higher, go much higher in price. By the way, here, this was the gold withdrawals. These are the.
Oh yeah, you tweeted that. Got a lot of reactions here.
Yeah, that's
on Twitter. Yeah,
that's people standing for delivery to get gold out of the comics. Yeah.
Yeah. What was that guy's debate about it? That I let it go on for a while. Anyway, thanks for David. Thanks for coming in today. Unless you have something else, and the content that you tweet.
That we've broken the trend here in standing for delivery. This is the last 3 weeks here. So, I mean,
people want it.
They want things that you can't print going into the year end. Yes.
They want delivery. It wasn't a trade. They just put it on for delivery, which is unusual in itself.
Real David Jensen is my Twitter, and I post the information I have, and you and I are in touch there as well. So
yeah,
keep the conversation going.
If I don't talk to you, David, Merry Christmas, buddy.
And to you, Dale.
And Happy New Year. Let's let's hang out in a hangout room or something. And,
let's hope the world doesn't stop turning.
Yeah. All right, David.
Okay.
Really. And I hope it's a great year for you. And thanks for spreading the word so people at least have some type of hedge for what might be happening here. I appreciate that.
My pleasure, Dale.
Everyone at Real David Jensen, follow him. One of the better minds I've come across, and I've interviewed over 1,000 people looking at things internally. So definitely should be part of your intelligence gathering. And that's a wrap for me, everyone. Remember, don't just count your pips or coins, count your blessings. And we'll be back with you tomorrow as the S&P is starting to fade. Adios. Thank you, David.
Thank you.
You're welcome, everyone.